Hi, and welcome back to the Fireball channel. Today I want to talk about our core investment strategy. The investment strategy is the part that makes all the other parts work. So um, uh, we want to make sure that we're following the whole plan. All of the parts of the Fireball plan fit together, and this is really the heart of why the other parts will work. Let me start by saying that the financial industry is made up of many more salespeople than investment experts. Salespeople are taught, often by other salespeople, to tell you stories that make very specific points, but may not have anything to do with your particular situation. Some of them that I've seen and heard, and I'll rebut them as I go. First of all, there will be salespeople who don't want you to be invested in the stock market. They're trying to sell you annuities or various other types of investments. Don't be invested in the stock market because, and then they pick out a specific time frame. This is a long time frame, 11 years, from the end of April 2001 to the end of May 2012. So an 11-year period that gained only 1,685 points, moving from some 10,000 and change to 12,000 and change. The total return for that 11-year period was just 13.6%. So if you divide 13.6 by 11, that's that's just a little more than 1% per year. If you were to take into account, some form of compounding, whether compounding annually or compounding, daily or continuously or whatever, it's even less of a return. You're still probably over 1%, but it wouldn't be even as much as the simple division here. And worse, this is what they're going to tell you. Worse is that the market goes up and down so much; it's so volatile. If you have the potential to only gain 1% a year, is it really worth the risk to be in the stock market? So my rebuttal here, this is going to assume several, and they're really ridiculous criteria. Number one, that all of your money that you will ever have invested was invested on April 30th, 2001. So you're only going to get the return, that this return over this time period. Number two, that you never add to it. Dollar cost averaging generally improves your returns, and that you need all that money back on May 30th, 2012. And that number three, the stocks didn't do anything except for make that market gain. There was no dividends, no other advantages to owning the stock. But if you're in this is the Dow. So if you're in the Dow, you've got, you're holding stocks of basically 30 of the biggest companies in the world in a pretty broad variety of industries. A lot of them, maybe most of them, are going to pay dividends over that time. So in addition to the the 1% a year, you probably made 2 or 5 or 8%, something in that area on annual dividends, where the stock the company is paying out a portion of its profits to the owners. Number four, you've also they've assumed that you've made no effort to educate yourself to improve your performance. There's certain indicators that can help you get better returns by getting into the best investment for the immediate future. And then number five, they're saying this on radio shows during 2018, when the Dow actually, so at the end of 2012, or I'm sorry, the end of May 2012, the Dow was in the 12,000 category, and in 2018, just 6 years later, it was well over double at 20 over 26,000. Certainly, it's come down since then, and it's going to go back up after that. So you just have to keep expecting the Dow to go up and down. But they just picked out a really particularly bad 11-year period and use that as their example. The second group of salespeople are the buy and hold crew. they want you to be in stocks, and they don't want you to make stupid decisions that will convince yourself to get out of stocks. So they want you to buy and hold and hang in just for the long term. One of the things that they'll tell you is that trying to time the market is like driving in heavy rush hour traffic. You watch the lane beside you speeding along, and just after you're able to change into that lane, it's the one that slows down. The lane that you left behind is the one that starts going faster, and everyone that used to be behind you is now passing you. When I drive in rush hour, I'll just give you this little hint. I clear the top of it. When we clear the top of a hill, I look forward, maybe a mile down the road to see which lane is going fastest in a mile, because those people are moving faster, and the traffic, just like an accordion, the traffic behind, that's the faster moving traffic, is eventually also going to move faster. So I get into the lane that's moving faster a mile down the road, and in a few minutes, I'm in the fastest lane. And then I clear the next hill, and I make the next adjustment. I look a mile ahead again. So I'm always looking ahead and not sideways to make my decisions. The same thing in the stock market. If you're just looking to see which investment is doing well today or did well this year up to today, you're looking at past performance, and there's always the warning that past performance is not necessarily indicative of future results. So at some point, the fund or the investment that's done better than everybody else is going to do worse than everybody else, or at least not as well. Something else is going to pass them. You just always have to be prepared for that. Another argument that the buy and hold crowd will give you is that if you're trying to time the stock market, it's so hard to do. And if you let's say you're in and out on a daily basis, if you miss just the 10 best days each year, if you mispredict the 10 best days of the year, maybe it's 5 days or 20 days in their specific example, depending on the year, you can potentially wipe out all your earnings for the year and make nothing, or make very little, or even lose money. So they're trying to tell you that if you are unfortunate in your selection, that those 10 best days of the year can wipe out your gains. My rebuttal then is that this is said by someone that's hoping that you don't understand what market timers do. Certainly there are going to be market timers who try to get in and out each day. There are day traders, everybody knows that. And some of them do very well. Market timers, as a broad category, don't necessarily try to sidestep just one day at a time. There are too many good strategies for me to explain. I'm going to explain one strategy as we progress through this video. But if you take into account this information, you might miss some very good days. But at least anecdotally, the best days, you can almost always expect a great up day to be the day after a big down day. It's usually called a bounce. And it happens when the market is very volatile. The market is moving up and down. You'll get those 10 best days in periods of time when you also have the 10 worst days. So if you're not talking about just a one-day sidestep, if you're talking about being out of the market for a period of time that includes one of those 10 best days, you're probably also including one of the 10 worst days. So if you miss both the best day and the worst day, here's the thing: the worst days, the market goes down faster than it goes up. So your worst days are going to be worse than your best days are good. So you may actually, by missing the 10 best days and the 10 worst days, do better than average. And then there's another argument here for, and this is the argument for the traditional portfolio model. It says cashing in your stocks to pay expenses in retirement is like spending the principal. So they'll give you examples like the farmer, he doesn't eat the chickens that are laying the eggs, because then he wouldn't have any more eggs, right? So you only want to spend the gains and never the principal. So they want you to buy investments that they claim are interest or income producing investments. Now, what they're doing here, certainly they're telling you it's not a bad strategy. It's kept people from wiping out their money too fast. I've got a different perspective on this that I'll explain to you as we go into the rebuttal. But if you categorize your investments into the time period of your life that you should be in them, then you are specifically not categorizing the investments into what is doing best today, what is doing best in the next the next few months or the next few years. What investment is going to actually make me the most money? Now, of course, the stock market can go up and down in value. The deception here is that most interest-bearing investments can also go up and down in value. If you hold a bond to maturity, so if you buy a bond that's got 10 years left and you pay $10,000 for it, and at the end of 10 years, you get your $10,000 back, that doesn't mean that in the middle that it didn't go up and down in value, just like a stock. If the interest rate on your bond is higher than a new bond, then here's the thing. Someone that wants to buy a bond can get a lower interest rate on the new bond, or they can come to you and buy your bond and get more, or they'll pay you more for it because it's earning more interest than a new bond. And the opposite is also true. If interest rates have gone down, or I'm sorry, have gone up, and so your bond is at a lower interest rate than current bonds, and you need to sell that bond to get more money than just the interest. You got to take into account that this can happen, that you can have these needs. Then your bond is going to have a lower value to someone who's buying a bond because they could get a higher interest rate on just buying a new bond. So you see how the value of the bond itself isn't fixed at 10%. You get your 10,000 back at the end of at its maturity, but in between, if you need that money, it's volatile, just like a stock. Maybe not quite as volatile, but it is volatile, just like a stock. So let's look at the rebuttal. The traditional portfolio model is not a bad way to invest, but there is this exact thing that I've just been explaining is the most glaring weakness. The investment that you own depends only on the point where you are in your life, and not where the economy is in its cycle. The U.S. economy and the world economy, the open market has a tidal power. The tide comes in and the tide goes out. The tide comes in, the tide goes out. A rising tide lifts all ships. You've heard all these things, right? There are forces that the tidal power is made up of forces that make there's three main financial assets. There's stocks, bonds, and the money market. One of those three is going to move better than the other two, and one of them is going to move worse than the other two. So pretending that the balance of a bond investment plus the interest payments is really a different thing than the balance of a portfolio of stocks has served the salesman in the financial industry well. They don't have to make bold predictions about market direction, which inevitably are going to have periods when they're wrong. Even if they're right from the beginning to the end, somewhere in the middle, they're going to be wrong. There's going to be bad days, bad weeks, bad months, maybe even bad years. But from the beginning to the end of their market prediction, if they've made a correct prediction, then they don't make those bold predictions, and they don't have to suffer the consequences when the prediction has, maybe even a very temporary glitch. So let's move on. A few principles that actually do have more relevance to almost everyone. Number one, over a long enough period of time, the stock market has always been a good investment. You'll hear things like it's made 10%, historically, the stock market has earned 10%, maybe 8 or 9%, or maybe 11 or 12%. The numbers depend on where they start measuring, where they stop measuring, and how they're accounting for compounding of gains and things like that. But if you are willing to ride out, if you're able to ride out the periods where your investment moves against you, then you're generally rewarded for your patience. Number two, market returns are generally enhanced by systematically adding new funds to your portfolio over the long term. This is called dollar cost averaging, and it's a good way to boost your investment returns. So when the market is up a little higher, and you're still investing new money into your investment, when the market is a little higher, the money that you put in is going to buy a smaller number of shares. And when the market goes down a little and you put in that same amount of extra money, your new money buys a larger number of shares. So if you buy a few shares at a high price and a lot of shares at a low price, then your average price is averaged down by by having more of them at a lower price. This makes your gain on average higher in general. Number three, the market will go both up and down. I can promise this. Supply and demand changes daily, weekly, monthly, yearly. The supply and demand for the stock market in general, as well as each individual stock in it, even changes, minute by minute, second by second. But it also, supply and demand changes for bonds, like I explained with the interest rates. Cash, sometimes, there's a market for exchanging. It's the foreign exchange market for cash. So you can, a U.S. dollar might be worth more or less compared to a euro or an Australian dollar or a yen from China, from Japan, or whatever. Your value of money actually goes up and down based on the supply and demand. Also, gold, real estate, a business that you own, all of these things can go up and down based on how many buyers and sellers there are at any given time. Something is always doing better and something is always doing worse than everything else. Now let's look at a few reasons why the supply and demand changes. First of all is day-to-day news. If you're watching the news, you're going to see good news, and probably even more often you're going to see bad news. And it's all that bad news always drives prices down. Good news drives prices up. I ignore it. It's too unpredictable. There are ways to take advantage of it, but that's not part of my plan. Scheduled news like earnings reports and economic data, releases their earnings reports or their unemployment and inflation, and all these things are accounted for and released in the economic data. Investors a lot of times are already taking into account what they expect those reports to say, and generally are pretty well right about it. So these scheduled events are usually already built into the prices of each investment. Next is sentiment and investor psychology. So when the stock market is doing bad, the investors will start to think, hey, the stock market's doing bad, and it changes the way they feel about the market and their willingness to be buyers and sellers. So they'll get in the bulk of investors can get into a herd mentality, and everyone kind of do the same thing. In 2000, during the tech bubble, Alan Greenspan, who was the Fed chairman at the time, called it irrational exuberance. So many people thought the stock market was doing so well and thought it would always continue to do so well that they kept buying and buying and buying. And eventually, a year or two later, the buyers dried up, and the stock market started coming down. There were other alternatives in the economy that were better places for your money. not because you were at a particular age, but because those other types of investments became better investments. They became more rewarding. So these things, and the stock market's going to all the financial investments are going to react to sentiment and investor psychology. But these things are kind of scary when they're happening. Not kind of. The scariness actually is one of the main reasons why some investors many investors don't do well compared to the buy and hold investors. So people who will get in and out, or are willing to get in and out of the market, will often do it at the wrong time because they're following this crowd mentality. So we're not going to actually take any action based on sentiment and investor psychology, but we are going to use the tools that we have to take a little bit of advantage of it. So what I'm looking at here is especially the next category, the tidal power of the economic cycle. The government and the banking industry steer the economy up and down. So they do this for a period of months or years. They'll set parameters. They'll set their parameters, and then a few months later, they may change the parameters. But generally, they'll set the parameters in a series of events. And as they're making changes, the market is doing what they're guiding it to do. And then when the market goes beyond what they've wanted it to do, they have to change directions. So when they change directions, you can expect the market to also change directions, the different financial investments to do the opposite. And this is where I'm willing to make high probability predictions. So we're going to specifically take advantage of this, but we're also going to work on the one above that just a little bit. What I'm doing here will also help us here. So what you're about to see is I like to generate charts. I like to make views that people haven't seen before. They confirm or reveal ideas that you don't find in the media or in being explained by salesmen and things like that. I'm a visual thinker, so I like to have the charts to gain the additional insights. And I also like to make things as automatic and emotionless as possible. So when you're losing money, it's scary. You need to keep your fingers out of it. Assuming that the investment will recover and that you're not, 100% in Enron or, was it Goldman Sachs that failed? If the investment is going to recover, it's a great time to buy more when it's down. So you want to invest more. If the investment is automatic and you can just trust it and you keep your fingers out of the process, you can greatly benefit from the recovery of an investment. So first, I'll show you how to insure or protect yourself from a catastrophic loss, something like Black Monday 1987. I was a young adult when Black Monday hit. The stock market in one day lost, the Dow lost 25%. It was, a pivotal event in my life about how I would view investing forever after that. I want to make sure that I never lose everything in a Black Monday type event. So I want to build in this protection just specifically to cover that possibility. Second, I'll show you my primary investment strategy. We are going to take advantage of the long-term growth in the market, but we're also going to take advantage of those tidal cycles, those the economy moving up and down. They're predictable because they're caused. So we're going to boost our returns dramatically by taking advantage of those predictions. Third, we'll explore some additional strategies that will take this insurance that I talk about up here, and we're going to do things that will give us additional benefits and reduce the costs of insurance. And then finally, we'll look at the step-by-step process uh, so that I can make sure that if you're going to follow my strategy, that you know exactly what to do step by step. So the first thing we need to cover is on protecting your investment. What I want you to do is, if you haven't done this already, is to stop this video and start to research on the internet or at the library everything that you need to know about protective put options, also called married puts. We're going to add a few twists to this based on our specific strategy. But you need to understand protective put options and married puts. In the next section, I'm going to discuss how to confidently pick the direction of the market over a period of at least a few months. Picking the direction doesn't guarantee that every day or any time period is going to exactly follow that prediction. Picking the direction certainly doesn't mean that we know how long the prediction is good for. That's never, the end is never part of the prediction. What we will know is that when we hit the next pivot signal, we'll see it, and we just won't know in advance what day that's going to occur. So that leaves us two problems. If the overall signal was wrong, and up to 25% of the time over the last 20 years, it's been wrong, the market direction is actually going to go against us. And also, there will be smaller corrections, and it will move against us. How do we keep our courage up when the value of the portfolio is dropping? So we need to whatever we can to make sure we're following the plan. Okay, and the solution to both of these problems is protected puts. So I probably read somewhere or heard somewhere that Warren Buffett always protects all of his holdings with put options. I don't know if it's true, but in our strategy, that's a solid pillar, and I absolutely require my investments to be protected with put options. And that's just just because Black Monday was the defining event in my life, and I've witnessed the chance to be ruined if the stock market treats us bad for just a single day. So, but after you've done your research on protected put options, you're going to be given one view of how much that you should pay for protected put. I'm going to give you another view. I'm not saying that the view that you've already read is bad. It actually is good, but in our strategy, I'm going to give you a better view. So this is all going to be dependent on your faith in the strategy. So let's look at a chart here to answer the question on what price to pay for your protected puts. I've created what I call elbow charts. They're histograms. So these are, instead of the chart could be turned on its side and you'd see prices from low to high. But I've done this just on kind of like a spreadsheet. So I wanted the chart to go side to side. Low prices are to the left and higher prices are to the right. So this is a chart of the QQQ. People will call it the cubes or the Qs. It's a popular exchange traded fund, and it's very popular. Also, the options that trade on it are very popular. So this chart is it has very smooth curve on both this red bars and on the green bars above it. The curve is very smooth. Other less traded options and less traded exchange traded funds, or any investment, stocks, bonds, whatever. Other charts will not be quite this clean, but we'll be able to work with them. So well-ordered is a mathematical term that kind of explains this for me. Well-ordered is is a term that they use for numbering, because 2 comes after 1 and 3 comes after 2 and 4 comes after 3. So numbers are well ordered. There's no anomalies, and that's what I like about this particular chart. So it makes it so that I can explain what the chart means pretty well. So it's hard to see here because of the size, but there's just to the left of this blue area is the first column. The first column is strike prices. So I've got strike prices going from low to high. And then the you should know what a strike price is because you've done that research on the previous page, right? So now, then the second column is dates. This is the current date for each of these. These dates are all the same because this chart is all made up of 1 day of strike prices. And then there's the red bars. Let's see, second column is dates. Long red bars are buyers. So the buyers have put in limit buy orders. Now, buyers are generally very sensible. They don't want to spend too much money. So you'll almost always see a pretty good smooth red curve. So a smooth curve in the red bars. It's the price that you could, if you owned the option, you could sell it at market and you would get the top red price. So then the green bars, the next one's out. In this chart, these green bars are all very small because the QQQ is a highly traded, a very active investment. On less active investments, these green bars they'll be speculators who are trying to get higher prices for what they own. So green bars indicate what you could buy the stock at. So you can sell it for the red price, you can buy it for the green price if you went in at a market price. Certainly, we're always going to set limit orders, and I hope that you've covered what market and limit orders are in your research. I'll talk about it quite a bit, but we won't really define it here. So this chart only goes up. It starts with the lowest price options available, and at the top of the chart out here is this is where the at the money was on this particular day. The QQQ closed at between 160 and 161. So that's what this price here is the 161 and the 160. So the market price closed in between here. So if we add more numbers to this, at the money puts, so my chart only goes up to at the money. You can see that prices start to get higher as you get closer to at the money, and they'll continue to go higher after the at the money. So if my idea here is that I want to control price, then I probably don't want to look at higher prices. I'm not even concerned with higher prices. I want to buy lower priced puts that meet my objectives. So on this particular day, at the market close, if you were to put in a last minute order, you could have bought an at the money price, at the money put at about $7.50. So it would have been just a little higher, just a little lower, depending on whether you bought the 160 or the 161. So if you wanted to hold the QQQ and you wanted to protect it with at the money puts from this November 22nd date till, and these options would expire in near the end of January. So this would be a 2-month period. Your cost would be, November to January. A 2-month period. Your cost would be a little over 5%. And then you'd also have to take into account some cost for commissions on the purchase. When you're doing research on options and protected puts, a lot of times the tutorials will have kind of a generic price here, and they'll just say, you can buy an at the money put at 5%, or maybe they'll use a 10% number, something like that. And 10% is not out of line if you're in an investment that actually is pretty volatile and moves a lot. You'll see higher priced options because the investors are also protecting themselves from that volatility. So, and you should have covered those principles in your research, but you'll take into account some of the commissions. So if you want to protect yourself all year, this is going to cover 2 months, but if you want to protect yourself all year, you'd have to every 2 months reinvest in in your protected puts. And if you've invested, let's just say you've invested 5% each time. If you do that 6 times, you'll have invested about 30% of your money. In some cases, especially when the puts are paying off because the market's moved down, you might be able to get some of your money back on the puts that you can invest in the next expiration date. So yeah, that's something also to consider. But what this suggests, that 30% number suggests, is that most good years in the stock market, remember I said over the long term, people will say roughly 10%. So a good year might be 30%, and a bad year could be 0 or minus 20 or minus more. But a good year is, if we're picking good years, probably the average is 30 or 40%. And so the at the money protected puts, if you're buying them on this 2-month time frame, they're really only valuable if you're fairly concerned that there's a pending news item that could damage your investment. For continuous insurance that I require, this is really too much to pay. We don't want to buy our puts at prices this high. So let's we're going to put that on the back burner and come back to it in a little bit. But let's look at the what I call the Fireball market direction indicator. So we're going to decide which direction the stock market's going based on this chart, and it's an ongoing project. These 2 bars are the same price, are at the same level, because this is the current level, and I haven't updated it because it hasn't changed. It hasn't made its final change yet. So, but so this chart doesn't show every value. It doesn't show the values for every day. I've filtered it down to pivotal moments that better illustrate my strategy. Also, additionally, I've included 2 different types of information here. There's the key indicator part of the chart, that that this is the parameters that the government and the banks are changing, that appear as actual stock market results on those particular days. So if the government made a change here and then the next change was here, then this bar shows, up here the market shows what happened from one to the next. Let's see. So you must realize that between any 2 points on this graph, on this chart, there's additional missing values, and they may be well outside the range of the values that I have here. So this may look like a peak, but it may be way up in here. This may look like how low it goes, but it may be way down in here. The volatility, this doesn't reflect all of the volatility. It just shows exactly where the price was on these particular, on the days for these particular changes. So, and I need to let you know that, because I don't want you to feel misled. There's going to be more volatility than this chart indicates. The financial industry systematically presents their results between specific dates, usually quarterly, so that you can compare them. I'm not trying to compare my strategy with other financial products or strategies. What I'm doing here is showing you how to move from one unknown date to another unknown date, not necessarily the end of a quarter. And that the pivot signal, the pivot point has signaled, so that you can make a better profit with a different method during the time when it should work best. And like I said a moment ago, these pivot points never really happen on the fixed quarterly dates in the financial media. Also, the dates aren't particularly important. Neither are the actual values. The chart illustrates relative information. So in other words, what I'm saying here is that this bar, and I'll explain that here in a minute too, represents 1,000, and this represents 2,000, and this represents 3,000. So you'll see that the 1,000 to 2,000 gap is a bigger gap only because I have more values in here that I needed to record. There's fewer days that the market happened, that the indicators happened to change while the market was in these ranges. So these bars aren't as far apart. These are just very specific prices at the date. So the values aren't important. They're just relative. So a higher one is higher, but it doesn't say how much higher, and a lower one is lower, but not necessarily considering how much lower. So like I said, the lower bars show the value of my indicator, the FMDI, and the upper bars show the value of the NASDAQ 100 on the day the key indicator changes. Now, over time, let's just put this in a time context. These first three green sections, so this green section and this green section and this green section, were all, this is during the time period of the, and including these red sections, this is the time period when you remember, if you remember the internet bubble, the tech and internet bubble of around the year 2000. So it was the turn of the century. It was the end of the Bill Clinton administration. And then, I'm just adding that for time perspective, not, I'm not making any political statements here at all. Then the next red section, this bigger red section, shows the bursting of the internet bubble. Third green section, or I guess it'd be fourth now, the fourth green section here is the time period when the second Iraq War under the second George Bush was president. And then the fourth section out here is the Great Recession, the fourth red section. This is when real estate prices crashed along with the stock market. So it was caused the bankruptcy of some banks, and it was a time period that when you were listening to the news, people were kind of rumoring. The rumor was that this was what might be known as the Great Recession. And then this last green section here is what we're in right now. It's the recovery from the Great Recession during the Barack Obama years and the Donald Trump years so far. So also I need to explain, there's this yellow bar here. This was the original level, right across the bottom of it, was the original level of the Charles Givens. If you've read Wealth Without Risk, as I recommend that you do, Charles Givens had an investment decision line right here. And then, I'm sorry, he had this orange bar was the investment decision line in his first book. Then in a later book, he changed it to this lower level represented by the yellow line. So the yellow and orange are the values of the Charles Given decision line. And like I said, he's changed it. The horizontal dark bars, these are 1,000 point increments. So this is under 1,000. This is 1,000 to 2,000, 2,000 to 3,000, 3,000 to 4,000, and this last bar up here is the 7,000 value. We've been above that in the NASDAQ. It's also come back down below, but we'll see what happens by the time they make these last few changes. So what we see illustrated here. Whoops, let me. Black marks are the pivot points. So each time my indicator indicates a change, and I'll explain these to you a little bit here. The indicator goes in the direction that we think the stock market's going to go. It also, when it reaches these low points and these high points, there's an additional change. So here we think the indicator is moving down, so I'm predicting the stock market will go. It didn't go down in that particular period, but the black point is the day that I would recommend a change, and then the black day is the day I would recommend a change again, and another change. So this doesn't necessarily mean that you lost a lot of money. You could have, but it could also be that you were in a different type of investment altogether and didn't experience this change. But that would depend on the actual investments that you choose. But anyway, what the chart illustrates is that, okay, so there's 8 changes on here. 1, 2, 3, 4, 5, and 6. The 6th one here are that the stock market actually did exactly what the FMDI predicted, and then there were 2 of them here, this one and this one, that the stock market went opposite of what the FMDI predicted. Doesn't mean that you lost a ton of money, but it means that we needed to make sure that we had our protection in place to keep us in, especially since these were particularly early. The earlier that you are in your investment, the bigger of an impact it's going to have later. That's why it is a great idea to start your investment early in your life. But so on this chart, the 2 times that it failed out of the 8 signals and they were in the middle of the internet bubble, which is not a completely unique event, but it's kind of they were kind of rare circumstances that caused these 2 failures. Over time, I'm going to expect additional changes in the economic cycles to more closely confirm the certainty of the key indicator, and they'll raise that certainty. That's what I expect. When the key indicator reaches a high point, or when it moves lower, we can expect the stock market to be high and move lower. And when the indicator hits a low point and moves up, we can expect the stock market to be at a low point and to move up. So from low to high, and while we're moving up, there's 2 different things going on here, but they're in parallel. We can expect to move from this black mark to this black mark. We're not probably ever going to hit the exact high, but what we're going to do is we're going to take advantage of this long trend, and then we're going to start looking for the trend to reverse, and then we're going to look for that trend to reverse. So over time, we should see great gains, because we're not losing a lot of money with the market itself. Okay. Let's see. So now let's talk about those protected puts and how we can squeeze additional profits in and squeeze the costs down. So we're going to take everything that I've talked about and form a cohesive context and strategy. I need you to realize that we're talking about 2 very risky investments. We're going to use, let's see, I'll just read the using each of them to counter the risk of the other. So options, if you've done your research correctly, you'll know that options expire worthless if they don't reach the strike price. And we're going to use leveraged ETFs, which means that we're not just in an exchange-traded fund, but we're in ones that will move faster because they're leveraged than the QQQ, for instance. So there's the QQQ, and then there's the triple QQQ that moves 3 times faster each day than the QQQ roughly. Options expire worthless, and these leveraged ETAs can actually, if we were to lose 33% or more than 33%, so more than a third, if we were to lose more than a third in the QQQ, then the triple QQQ is going to go down 100%. It's going to go down 3 times as fast. That means that you could actually, if it moves down more than 1/3, you could actually lose more than 100%, and you'll end up owing the brokerage money. This is a very rare thing, but I've heard stories where it does happen. So if your investment that can lose more than you've invested, you can wind up owing the brokerage the difference. Both of these can drop in price surprisingly quickly. So we've got to consider those risks, and then also here's a primary risk. There's the opportunity cost and opportunity loss risk. If we're not taking advantage of the power of the economy, then that we're risking that we're missing out on the possibility that it can make us wealthy. While it's true that there are people who have lost everything in the stock market, I've met a few, heard lots of stories, and it's also true. While that's true, it's also true that the number of people who never tried investing in the stock market and because they've never tried, they have nothing to show for it. Those people far outnumber the few people who've lost everything because they tried, even though they tried. So as we continue to address the next few risks, you need to at least consider putting a little money aside and letting it hopefully potentially grow in the stock market for your benefit over the next few decades. Risk number two is the catastrophic event from the catastrophic loss from a one-day event like Black Monday, 1987. I've talked about this before, but let me just go over this again. October 1987, the stock market's had been making steady gains when suddenly the Dow Jones Industrial Average dropped 25% in a single day. By the end of the year, at the end of December, it had not yet regained its pre-October highs, but it had regained enough to make a small gain for the year. So even though the Dow lost that much, the Dow for the year was still had a small, I think it was 3% or something like that, a gain for the year. Now, the FMDI didn't warn us. It didn't signal a sell or a market direction pivot, and I don't see anything that really did. There's nothing that I've been able to discover in all my research that explains why the Dow did that, except that it was trading that just one computer sold, and that triggered the sale on another computer, and a bunch of computers just started selling based on what other computers were doing. So there was a giant domino effect. Some of that's been mitigated by regulation, but like I said, you can never, even though they've made the attempt to prevent this from ever happening again, you can't. It's there's no way to predict all the possibilities that may in the future cause an event like Black Monday 1987 or worse. So it and Black Monday, because maybe partly because of the regulation that they installed to try to prevent it from happening again, hasn't happened again since then. But if it happened once, it could happen again, and I'm not going to stomach the risk without the certainty of my insurance, my protected puts. So by investing in leverage ETFs, I'm at a risk of a total loss. If the Dow lost 25%, the NASDAQ could easily lose more. Say, if it lost more than 33%, then you're in 100% territory for a loss in the triple NASDAQ. So in my mind, if we're investing in leveraged ETFs, this requires that we also invest in protected puts to prevent that total loss. And you have to have that coverage every day, because you can never predict which day is going to be a Black Monday. Third risk is if we were to spend too much money on our protected puts, we could wipe out our gains. So we need to make a determination here. How much are you willing to trade off from your annual gains to maintain that constant insurance from protected puts? And let's just do the numbers on a couple of examples. If I want to spend 1% per month, so I'm going to sell 1% of my shares every month and use that to buy protected puts. If they do that every month, we're going to wind up selling. We're going to wind up spending 12% a year on protected puts. Now, remember, I talked about a great year being maybe a 30% gain. So now we're still looking at maybe a little under 20% gains. We could protect our investment a little tighter. That would be a lower. You'll see some option tutorials will talk about that. This is a steep discount, and so it would be like a high deductible on your insurance. If you have $100 deductible and you wreck your car, you've got to spend $100 to get it fixed. If you've got a $500 deductible, you've got to spend $500 to get your car fixed to restore it to normal. So the amount that we're spending here is offset by the deductible. And at 2%, that might be 24% a year. So if we have our good 30% years, we might be down to about 6%. You just got to decide where your threshold for that deductible versus that percent per year is going to be. So, and I can't make that decision for you. Each of these is okay. And even higher if you want to go a 0.5% per month, or 3 or 4 or 5% per month. That's entirely, you just can't decide that for you. It has to be your decision based on your comfort level, what level you'll be able to stomach as a deductible when you need the cash in the protection. You can also consider other time frames, like a quarterly time frame. So instead of buying renewing your puts every month, you might renew every quarter, and then you could use completely different numbers. Like 2% a quarter is what 2/3 of a percent per month, something like that, or 1/3. Let's say quarter. Anyway, so you'd have to work it out. There's a little math here. If you push the expiration out a little farther, the prices are going to be a little higher. So you might have to settle for lower strike prices to get that same percent pricing level. But again, that's entirely up to you and your comfort level. And then here I explain it again. The 2% figure lowers the annual performance more than the 1% level. So the trade-off is this: if the market does move against us, what do you have to get back to stay in the program, to stay on plan, by selling the puts? In other words, what do you have to get back to avoid abandoning the plan? We don't want to abandon the plan. We want to use our protected puts to give us some relief of the losses that we might experience. So the more you have invested in the same number of contracts, the higher strike prices you can secure. So the more you'll recover in a complete loss. Even then, as we'll see in a moment, the more you can gain in smaller short-term loss. And always remember, we have an objective for our exchange-traded fund investment. That is to go from price point to price point and make from pivot point to pivot point and always show a gain. That's our objective. And then we have an objective for our protected put insurance. That is to get some of our loss back if this part has a temporary correction, or a longer term correction, or if it was wrong to begin with. So we want to get some of our investment back if the ETF investment goes the wrong way, whether it's short term or long term. And if we can meet both of these primary objectives, then we have some secondary objectives also, and it's just a matter of your own comfort level, your risk tolerance, and we'll cover how this might work out for you. So, and here's exactly what I'm going to talk about. So, the short-term losses persuade us to abandon our strategy. This is like a salesman who comes in after the stock market's lost some money and says, "Hey, I could have put you in an income investment instead, and you wouldn't have lost that money." Well, you may not lose the money while the stock market's losing money, but you'll lose money in your income investment in other time periods. So we don't want to abandon our strategy because it does exactly what we said it was going to do, and for a period of time lose some money. So this is one of the modifications my strategy introduces for protected puts. We're going to take full advantage of what's called rolling out or rolling down your options. So to make sure that you've done research on these terms, but maybe they'll become apparent what I'm talking about as we discuss it here. So remember, the main goal of our investment portfolio is a gain from one pivot point to the next. And the main goal with our protected put element is protection against a catastrophic loss, a wipeout. We can lose some or even a lot of value and still be okay, but there must be something left to rebuild on the day after a market disaster. If there's 100% loss, we want our protected puts to restore some of our loss, some of that 100% loss, and keep us in the stock market. Hopefully if you've done that and then you come in the next day and restore your stock market position, you need to also restore your put position to make sure that maybe the next Black Monday is a series of Black Mondays. We don't know what might happen. We need to always make sure that we're protecting our investment. But watching your portfolio value fall takes courage and a lot of it. And I think I explained this before, but this is why investors fail, and even market timers fail, because they see the dollar shrinking and they just can't take the loss. They just can't stomach the loss. It is going to happen. If you stay the course, you will be rewarded. That's a platitude. Be patient and be blessed. That's another platitude. There are so many slogans for this period in the investment cycle. Remember this, there's no slogan that says to escape. There's no slogan that says to abandon the plan when your portfolio is doing exactly what every expert says it's going to do and takes a short-term beating. There's, like I said, you're going to have salespeople come in and try to talk you out of being in stocks, but they don't have a slogan for that. The slogans are be patient and be blessed. Stay the course and you'll be rewarded. Buy and hold out for the long term. And so that's why I include this additional incentive for you. We know, and when I say we know, I mean we all know that the best time to invest is when prices are low, right? If you're going to buy low, sell high, step one is to buy low. It's the imperative. If you want to sell high, you had to already have bought low. But where does the money come from to buy low when the market is low? You're probably your concern is you're making sure there's money to pay the bills when the market's low. And then how do we know that when we're dumping extra money into our portfolio, are we dumping it in at the best price, or can we expect the market when it goes low? It can go lower. So I built this into our strategy as well. And my answer is I let the puts decide. I place what's called a roll down order that's triggered when my existing put can be replaced by a new lower priced put with some built-in profit. So the built-in profit is invested in new additional shares of the underlying investment, the leveraged ETF. Now, some brokerages will allow a contingent order that lets you put this all together in a single transaction. So what you're going to do is you're going to sell your old put for a profit. If you're making a profit, if the market's going down, a put will go up in value. Or if your underlying investment is going down in value, your put will go up in value. So your protective put is making a gain. You're going to take advantage of selling that put at that gain and buying a newer, lower priced put. This will continue because we still have the new lower priced put. We still have our primary objective met. We still have protection from the catastrophic loss. But we've squeezed some of the profit out, and we've reinvested profit in, guess what? These stocks went down in price. So we're buying lower price stocks to add to our portfolio. This is exactly what we want to do. It's step one of buy low, sell high, is we're buying stocks that are lower in price with money from our put that went up in price. So we were able to sell the put high and buy the stocks low of the same underlying investment. So this allows me to keep my primary objective for my protected puts met, just with the new lower strike prices. It also allows me to convert some of the profit of the gains on the previous put to grow my number of shares on the underlying leveraged ETF. And like I said, this is exactly what everyone wants to be able to do in a market downturn. This transaction, the order that you can put this all together in a contingent order makes it automatic. Then after the transaction executes, we place the new, we wait till the end of the day, and we place a new order to do exactly the same thing. It's a new roll down order. So we've bought the new lower priced put that keeps our primary objective met. So our secondary objective is to take that new lower priced put and put a roll down order for an even lower priced put. So if the market goes against us again, we can buy even more of our underlying stock. So if, for instance, I'm buying 1% every month in protected puts, and so I have to sell 1% of my leveraged ETFs. If I've got 1,000 shares, that means I'm selling 10. So if I sell 10 shares in a month to buy 1% in protected puts, I know that's going to happen every month. It's a permanent ongoing expense, okay? but my puts show enough profit to replace that 1% of shares. So I sell my old put, buy a new put, and I can get 1% back. Then for the month, my protected puts paid for themselves. And if it triggers again, then I get another 1%, or maybe I'm working on 2% or 3%. I'm building a stronger portfolio from the profits of my protected puts. When the ETF, when the leverage ETF prices eventually return to their new highs, or go back to new highs, or even just to relative highs, I'll have more shares than I originally expected to have at that point in time. And then, so here's my fourth point that I told you that I'd cover for you, is that we're going to talk about this step by step. Finally, how is all this accomplished? First, we place an initial investment, and each time you add more money, you consider it a new initial investment. So let's assume the 1% monthly insurance cost. That means we're going to put 99% directly into the underlying investment. I keep saying leveraged ETFs, but it's the investment of your choice. I can choose any of the broad market ETFs, mutual funds, or other ETFs. There's ETFs that will give you the long side or the short side of bond funds. There's sector funds are not really appropriate for this strategy because sectors rotate and you're not really following the FMDI with a sector fund. And then as soon as I underlying ETFs, I also purchase the puts. I might actually purchase the puts first to make sure that they're purchased as I'm purchasing the ETFs, in case that's the moment that the crash happens. I want to have those puts in place as soon as I'm the owner of those shares. So if an option contract is 100 shares, I own in the neighborhood of 100 shares, then I want to buy one contract. If I own 200 shares, I want to buy 2 contracts. If I own 1,000 shares, I want to buy 10 contracts, et cetera. If I keep out that 1% of the shares so that I can spend that on the protected puts. Then after the market closes on this day, and there's a reason I say this, it may not apply to you. If you've got enough money, you may not be worried about being called a day trader. But if your portfolio is below, I think there's a $50,000 limit on. You have to have that much money in order to qualify as a day trader in your account. So this will help prevent that from causing you problems with the brokerage. So after the market close, I'll go in and place my roll down order. So let's look at how to determine where that roll order should be and where the new put should be. This is where we're going to use our elbow charts. And looking at it, you'll notice that there is an elbow, the apex in the pricing curve. Above the price, the market, the curve is straighter, and below the elbow, the curve is straighter. But at the elbow, it's the most curved, so that's why I call it the elbow. We can often, depending on the investment we've chosen and the time frame we've chosen, and things like that. So it doesn't always happen, but and if we're in an investment that's more volatile, that moves, this might not be true, but often we can find that the initial 1% price that I like to use is near the elbow. So as the stock price moves up and down, the at the money level also moves up and down. That's by definition. The at the money is the level just above and below that stock price. But the elbow also moves up and down. So when I say up and down, I mean literally on my elbow chart, because it's built sideways. It's moving if the stock price goes higher in the chart, which means it's gone lower in value, then the elbow is going to move higher on the chart and lower in value. But what I'm saying here is the elbow moves the same direction as the at the money level, which moves the same direction as the stock price. So now if I know I need to generate 1% to make the roll down transaction, here's what I need to know. I look for a higher price that meets this need. When I find it, I'll be able to see the relative strike prices for the sell and the buy the buy transaction. I place my order using the higher price to sell my existing put and the lower price to buy the new put. So here, I'm going to put some numbers to it to help prevent confusion. Let's say, for instance, there's a price that the put costs and a strike price where that put price exists. The example is, let's say the stock price is $50. Okay, 1% of $50 is 50 cents. So I want to spend, for every share of stock, I want to spend 50 cents on puts. And so that will be the put price if I'm buying one contract to cover 100 stocks, or 2 contracts to cover 200 stocks, whatever it is. This is the price of the put. And if the price of the put occurs at the $30 strike price, this is just an example. This may or may not be true, but let's say the $30 strike price has the 50 cent put. Then I want to follow the curve up until I see a 1% total gain. That would actually be down. As the prices go up, you're looking farther down on the chart. So to see a 1% total gain, that means I bought it at 50 cents. That was 1%. So to see a 1% gain, I need another 50%. So that's $1. And then if we're going to work in some commission, it'll be a little over $1. Now, when you place the order, look at the brokerage's estimate of your funds, of your the funds that the transaction will create for you, and make sure that you're getting your, if you want to make certain that you're getting your 1% gain, then your gain needs to show $1 per share gain. So so we've moved up. Let's see. We want to determine the strike price at that point. So if we've gone from our 50 cent strike price at $30, and we're looking ahead to a maybe to get to the $1 level, we're looking at $36 strike price. That's a $6 difference in strike prices. We can reasonably assume it will occasionally vary, but we can assume that in general, we can also look at the lower prices on the curve to find the same gap in strike price. So if $6 is our price moving up to $36, then $6 moving down would put us at the $24 strike price. This would be the lower priced put that we want to buy as a replacement. So when my $30 put moves to 36, the $4 put should move roughly up to 30. You may need to adjust this as you see, some variance or some anomalies in the chart. But just in general, this is what we're looking for. So I place my roll down put at this strike price, and the put price locks in the gain for 1%. The elbow chart helps make it clear. Where if I was to just look at the option chain that you can get on, Yahoo Finance or MarketWatch or wherever you're getting your financial information, it's just numbers, and it can be really confusing just looking at all those numbers and all those extra numbers. Here we've got strike price and put price, and then we're looking at the new strike price and the new put price and the replacement strike price and the replacement put price. So this chart makes it simpler and more clear. Anytime the roll order triggers, I want to wait till the end of the day to avoid being classified as a market trader, but then place a new roll down order. So if it triggers and then the next day it would, you've got your order in place, it might trigger again. You could find yourself, if the stock price is moving rapidly, you might see these roll orders trigger in rapid succession. And then the number 5 in our steps, when I reach the end of the first month, when my puts will expire, and you know from your research that puts expire on the 3rd Friday each month, and then there's other puts that you can get in the intermediate in between those. But I like to, it's easier just to try to stay with the most popular, the 3rd Friday expiration puts. That means in the last few weeks of the put's date, you'll be in the month of the expiration, and that's when the price deteriorates rapidly. So I really don't care for my puts to deteriorate in price. About around the beginning of the month, or maybe even a little earlier, I'll start to place my rollout orders for the next time period. Remember, if the market has behaved ideally and followed the FMDI strictly, then my existing puts should be at or at least near worthless, because I've made gains on the underlying investment, which is the ultimate goal, is to have the underlying investment take my investment higher, take my portfolio value higher. If the market recently went against us, the puts may have some residual value, even if you didn't see enough gains to trigger your roll down. You might still just be able to capture a portion of it in the rollout transaction. And roll out means you're going to a further out date, right? So the roll down is a lower price, and the roll out is a date further out. If up in here you can get the roll down and the roll out at the same time, that's more power to you. But for sure, when our options are about to expire, we have to roll out to make sure that we maintain our 100% coverage, our insurance on all of our investment for every single day. And then if we can get that, if we can recover some of that price, we can use it to reduce the next protected put purchase. You'll need to also make sure that if you try to do that, that you're not actually spending more in commission than what you've got in that you're recovering in price. So if that's the case, then just buy a brand new put with brand new money and only pay the commission on the new put. Don't also pay the commission on the old put. So what can you expect from further videos? I'll still be producing. I've got a lot more to do here. We're going to continue to discuss how to accumulate some wealth, not just for retirement in some obscure future that, when you're in your 20s or 30s, you're not thinking about retirement. Usually. I think about retirement every day because I'm in my 50s. But really, if I could have got my start earlier and not lost my retirement benefits in personal events that I won't discuss here, but I'd be so much better off right now. But if we want to accumulate that wealth, we're going to accumulate it for your retirement, and we're also going to try to remember. I said that because our investment works well, it's going to trigger other benefits for us that might help us out this year and next year with short-term investment gains. I'll show you how to get yourself out between the rock and the hard place. Basically debt. This is the rock and the hard place, and we're going to carve our way through any debts that are affecting you. And we want to benefit like the millionaires and billionaires. We want to benefit from the tidal power of the American economy, of the stock market. Just always remember, I'm not a financial advisor, and I'm certainly not your financial advisor. So you can't take this as strictly as advice. I'm just showing you options. It's something that I want to share with you. It's definitely something that I share with my family and my kids. I want them to know. I want them to understand. And you're welcome to suffer through it for the entertainment value, educational value, historical value. Like I said, I'll be posting more videos. Some will be on financials, and there'll be some on tech and computer programming. I like to automate things. And then somewhere in there, I'll reveal more of the reasons why I've chosen Fireball for the brand. If you wouldn't mind, please try subscribing, and I'll talk with you again soon.